Hi, and welcome to another episode of the Financial Freedom Podcast. I'm Steve Richardson, a bankruptcy attorney trying to keep people on their path to financial stability and independence through education. One of many financial tools in the retirement savings toolkit is the annuity. Most people have heard about them and that they provide a stream of income, but beyond that, not much is known. That's why in this episode of the podcast, I bring back repeat guest Michael Karwic to talk about what annuities are, how many types they have, and how they can fit well into your retirement investment strategies. My guest today is another repeat offender, being on the show for a fourth time, having been in episodes 95, 101, and 194, which I think is a record. He's a certified financial planner and a certified financial transitionist with over 25 years of experience in the financial planning industry. He provides financial planning and wealth management strategies for clients throughout the United States. In addition to traditional financial planning and wealth management, Michael has areas of emphasis in helping people who are experiencing significant financial transition events and in working with families who want to have a thoughtful plan for the transition of their wealth and their values to future generations. Welcome back to the show, Michael.
Thank you so much, Steve. Glad to be here again.
Yeah. So we've talked in the past, and we were saying before we hit record some of the other topics we've talked about, 529 funds, which are basically educational IRAs or college funds, and how to deal with your investing in a down market and things like that, topics like that. But today I wanted to talk about one of the nuts and bolts things of financial planning, one of the tools in the toolbox. And we talked about bonds too in another episode, another tool in the toolbox. This one is annuities. And I don't know how much folks out there, the listeners, know about annuities, what they are, whether they should have them, things like that. So I thought we'd provide in this episode a good primer on annuities and step folks through it so they know what questions to ask a financial planner in setting up their portfolio or in modifying it. So I guess the first question, Michael, is what exactly is an annuity?
And I get that question a lot, actually, Steve. So, yeah, people come to see me and they say, I've heard about these things. What in the world are they? So, it's actually a very common and good question. So, let's, I'd love it to be a simple answer. It's a little complicated, but let's walk before we run. The easiest way to think of an annuity and the longest term definition, it's simply been a stream of income payments over a long period of time. So, as an investment tool or a product, if you want to call it that, annuities go way back. Actually, I did a little digging and I found a cool fact that they've been around. Annuities have been around at least about 2,000 years ago, since the Roman Empire, when the citizens could give the government a chunk of money and the government would promise them an annual stream of cash back for the rest of their lives. So, at its core, the simplest version, and we'll talk about some more complex versions, but the simplest version of an annuity does work a lot like that 2,000-year-old version of a fixed annuity, which is just a stream of income payments for some designated period of time. Often it's for the rest of your life, but even there are some decisions that can be made or some different nuances there.
So in essence, and we had talked before, when we weren't recording, that there aren't a lot of companies these days that offer pensions. But this is sort of almost a do-it-yourself pension, the way you describe it. You contribute money regularly into that fund, and then when you retire, it provides you with a stream of income, just like you would pay into a pension while you're working. So
Yeah.
we're going to see how that fits into the portfolio, but that may be another way of thinking about annuities, right?
Oh, 100%. Yeah. And if we think about that classic annuity that I mentioned, the fixed annuity, very conservative, but you know what you'll be getting paid out on that. Really, there are even two ways that people tend to enter into those. Sometimes people have a life event or a reason that they have a lump sum of money. They have a chunk of money and they're trying to figure out where to allocate a larger amount.
Mm-hmm.
So you can go into an annuity with a one-time payment or a one-time investment in your future.
Mm-hmm.
And at that point, we would look at different lengths of time you want it for, like we talked about. There's some variables in a good way that are available to people. How long do I want that income stream? When do I even want it to start? You might have a lump sum of money today and say, well, I don't need this money until, let's say, starting 10 years from now, I'll need some income, and then I want it for the rest of my life. Or then I want it for 20 years, or maybe I want it for the rest of my life and my wife's life as well, whoever lives the longest. So The one way you could do that is with a lump sum if you had some life event, and sometimes we structure it like that. And like you said, it's almost building your own pension plan, right? When you may not have an actual pension plan through an employer, but you came into a chunk of money through a business sale or an inheritance or any other event in the world, and you want to secure your future with some of that money. So that piece you might put into annuity. And the
Mhm.
other way is some employer plans, some school districts, especially. There are a number of places that through your workplace, you might save up money uh, while you work there and get an annuity, a pension plan in the end. Those are rarer, but you could set up your own annuity plan where you save up, you pay into it every year, and structure that for your own retirement or whatever the goal is. We typically
Mhm.
talk about retirement, but really, an annuity is when you put a chunk of money away so that you can have future income streams annually, usually for some long period of time. But it's really whatever you want to design. There is a lot of flexibility, and we'll even talk about other kinds of annuities next that are so they get a little complicated, but really that just means there's lots of choice out there.
Mhm. So we got annuities now, and we talked in a previous episode about bonds, and there are different types of stocks, common stocks, preferred stocks, and different types of uh, industries in which you can invest. And there are mutual funds. There are all these options out there of the different type of investments. How do annuities differ from other investment vehicles?
All right, so let me expand my definition to answer that, right? So I talked about the fixed annuities, which are pretty straightforward, right? Either through saving up annually for a long time or through an employer plan, or maybe you just have a chunk of money and you want it to give you a guaranteed income stream of some amount in the future. So that's a fixed annuity.
Hmm.
You could also have a variable annuity, which strays. Well, it's good for people to know, for your listeners to know about variable annuities in the context of your question, because you're asking how does that jive with other things they invest in. Variable annuities came along not 2000 years ago, but I think at the most maybe 50, 60 years ago or so, where they within this annuity, instead of giving you a guaranteed income stream in the future, in variable annuities, you get to invest in things that are like stocks and bonds, more mutual fund like tools that you're not sure exactly how much your fund is going to grow to in retirement, but people would use a variable annuity or a closely related third type we'll talk about are index annuities, which are very similar, a little different, but very similar to variable annuities. Well, variable and index annuities are meant to put away a sum of money when you don't want to be limited to just that fixed return, which is normally a known amount, but a low amount, right? When with the guarantees tends to come lower rates of return. It's a natural part of the investment world. If you want to strive for a little higher returns, you could use a variable annuity or an index annuity, in which case you're investing in things that are like other investments in your portfolio. So you've got the capability to grow it by more, but typically there it's not as guaranteed.
Hmm.
Um, so in summary, you might use it to stretch for a little bit higher rate of return. You might use a variable and index annuities for a higher rate of return than a fixed annuity would provide, but they'll be more like other parts of your portfolio, just a little bit more safety with some of the other features that you might look at. In summary, this might be a nice, this being all of those annuities that we just mentioned, might be a nice complement to having other investments that are at the full exposure of the stock or bond market or what have you. So I think like a lot of things, annuities can fit into a portfolio, but just as a piece of it that will complement some of the other investments. They'll have some of the risk of your other investments, but they also still retain some of their safety features.
Hmm. Well, getting back to the fixed annuity, I mean, I see in your description the variable annuity moves more towards those other types of investments like stocks and mutual funds and things like that. But the
Mhm.
fixed annuity, and my original question is how it differs from some of these other investment tools. Let's talk more specifically about the fixed annuity. How does that differ? And isn't I always understood, and maybe I'm wrong, that an annuity to be more of an insurance company, insurance vehicle, as opposed to an investment in stocks or the stock market.
Oh, absolutely. Yeah. So when we're talking about the core annuity, much more like your earlier reference to a pension is the best comparison for that. So when we help clients build a portfolio for their future or figure out where their income is going to come from in the future, one of the first things we look at, even before where to invest the money, is where are your guaranteed income streams? So it may be a pension, although you said that as we teed up this conversation. One of the reasons we're talking about annuities is fewer and fewer people have pensions available, right?
Mm-hmm.
So when we look at people's income in the future that we know about, Social Security and pensions are about it. Other than that, people may have lots of investments or IRAs or other things in a portfolio, but in terms of known income streams, they don't tend to have many. So
Mhm.
a fixed annuity is a great place in there to say, all right, I'm going to segregate a chunk of my funds and put that away for instead of in the stock market, in the bond market, anything like that, just you're turning that piece of your assets into a known income stream in the future. So then you can map out when I turn 62 or 65 or 70 or whatever you want to plan for. At that age, I'll start having, let's say, Social Security as a baseline. But if I would like to have some other guaranteed income, you're going to take a chunk of your money in some fashion, and instead of having that at the market's whims or perils, you're going to know that you get an income stream from that at that point. So now you've got at least two, if not three, guaranteed income streams, right? Social Security, maybe a pension, but certainly an annuity you could set up. Then some of your other money can be allowed to take a little more risk and fluctuation in the market because you have more safety of known income, monthly or annual income in the portfolio. So we use it as a complement to that other, call it riskier type investments in perhaps IRAs or other investments.
Mhm. Well, let's take a peek behind the curtain a little bit here. You mentioned other things being a little bit more risky. And then look at, I mean, different people have different risk tolerances. Some people are so risk averse that they just put their money in CDs or in bonds or in things that are very safe, whereas others are much less risk averse and invest heavily in a lot of these growth stocks or growing businesses or IPOs. Uh, how does the annuity or the more specifically the fixed annuity right now, how
Mhm.
does that relate to uh, riskiness, and how is that money invested? I mean, they're taking your money, they're putting it in something that will be able to generate a guaranteed income later. Well, how can they make that guarantee? What is it being invested in, and what's the risk factor on that?
Yeah, the risk factor, because you're correct, these are typically issued by insurance companies themselves, right? So you are being backed by the credit worthiness of the insurance company,
Mhm.
plus the fact that that industry is very highly regulated. And just like some other areas of the world, like pensions at corporations, there are insurances and guarantees and requirements for those companies in terms of how much they have funded those annuities or even pensions work the same way as companies have to have a certain amount of investment backing that future obligation.
Mhm.
So there is a lot of safety in the annuity world because they can't be the riskiest portfolios in the world behind the scenes. If you look at the balance sheets of these annuity companies and what they invest that in, you've got their full balance sheet at your, I don't want to say at your disposal exactly, but yeah, they're typically invested in the most conservative investments behind the scenes with the guarantees from each insurance company that's out there. And you can look at the ratings of the insurance companies as well, and you can see the different strength that the insurance companies have. If you were to, as opposed to having one through an employer, if you're talking about acquiring your own annuity, yeah, you'd want to check out the ratings and the strength of the insurance companies. I won't list any specific ones here, but you can find some really nice big name companies, and so you've got their full balance sheet at your beck and call. We'll call it. The second thing they do well is actuarially, they know they'll be okay if they have, which is to say, if they have lots of clients. Like if I get an annuity, they don't know how long I'm going to live. I might give a chunk of money to an insurance company, right? That's a classic insurance. Well, that's how insurance works, right? They're going to insure my future payments for a certain number of years till they expect I'll live. They don't know if I'll live that long or not, but none of these insurance companies are just issuing one or 10 or even 100 of these policies. They're issuing thousands to hundreds of thousands, if not more. So the law of large numbers says they do know actually how much they're going to have to pay out over time because of the law of large numbers. And so for that reason, they don't tend to miss very much on when they've estimated, if I give them $10,000 or $100,000 or any number under the sun, they know roughly what they can afford to pay me. So that's where some of the safety comes in. They know what they can afford to pay people at large. If we had to
Mhm.
make a deal with one person and you weren't sure how long you were guaranteeing, there's some risk on the table there. When they've issued this policy to 100,000 different people, on average, they're going to be right. They'll make their little bit of money. So these things aren't free, right? But they'll make their little bit of money because they know how much they can afford to pay me for my rate of interest, for the low rate of return they tend to make on the money behind the scenes, but then they know the mortality rates out there. So they'll get their piece of the pie, but we'll get what we're guaranteed to. And that's more to your point is for investors, do we get what we're promised? And we do.
Mhm. And on the issue of risk and like choosing the right insurance company to get an annuity, it's the risk is to some extent in who's offering it and how good they are at investing this money conservatively and everything else. But insurance companies are rated by at least two companies that are probably recognizable to our listeners, Standard and Poor's and AM Best, and you can look at those ratings and see how they compare and say, well, geez, this guy's got a AAA rating with AM Best. They've got, this, it's really good. So that's a way for listeners to shop around for a fixed annuity to see how solid it is and whether it's a good investment, right?
Yeah, and I hate to have a blinding flash of the obvious here, but I'll caution people because I've seen this firsthand. So I'll warn you, is people have come to me shortly before their retirements and said, I looked at all these different big companies, and again, I won't list them by name, but you know the companies and look them up, and here are their rates on a lifetime annuity. Here's what they'll pay me is if I give them $100,000 of my retirement money, here's what one company promised me, and here's what the next one promised, and they're all off by a little bit. And then, but I found this other one. I've never heard of them, but they're paying 1.5 times what these other guys are. Nice time for a red flag there. Take a step back, do the research. Like you said, look at both of the rating agencies that look at these. But do remember, especially for fixed annuities, because especially because they're on the safest end of the spectrum, there isn't for fixed annuities, just there's not a ton of variability in what they'll promise to pay you out there. There's some variability. If you find someone that's off the charts in what they're offering, like a lot of things in the world, there's probably not really a free lunch. You're probably, if it is a legitimate company, it still may be risky off the charts or way riskier if they're able to offer you more. There's no free lunch in the fixed annuity world. So
Right.
yeah, you look at the nuances, but that's it. Yeah.
Now, the income, the guaranteed income, I know I'm active and a member of the Knights of Columbus, very active with them, and they have a lot of fraternal benefits. And one of them is their annuities. And right now, they said if you get this annuity, if you pay into this annuity and start one, they'll guarantee a 4% rate of return.
Mhm.
Now, is that, I mean, I think I have an annuity with one company that we got into a long time ago. But is that basically how it works with annuities? Will it say, at this point, this is what we're offering in annuities, this percentage rate, and if you get in now, this is the sort of the guaranteed rate. It might be higher, but it's at least guaranteed at this level.
Yeah, that's right. So there can be some variability in there because rates will change over time, right? So over time, when you're in the accumulation phase, which is the savings phase of your life, whether we're talking 401ks or annuities, there are two main phases, and one is when we're saving up for that goal, usually retirement, and then the second one is the distribution phase, which is later on during the accumulation phase that you're talking about, while you're saving and earning, they may not have a guaranteed rate for the whole time that you're saving up because rates will change in the world, but a lot of them will have a guaranteed floor, is what you were referring to. So they'll
Right.
say, hey, look, if rates are better out there in the world and rates go up, you'll participate in that to some extent, and they'll have a way that that's calculated. But they might also say, no matter what, you won't get less than X percent. It might be 4% through Knights of Columbus, might be 3% through someone else. But
Mhm.
so again, you'll see a little bit of variation in the market because they can be a little different. Those floors can be set at different levels.
Mhm.
They're usually right in the same range, though. Some of it is a regulatory issue where they have minimums that they have to guarantee, and others are where companies are trying to compete a little bit for your business. But the way you described it is perfect, which is they'll probably have a floor or a minimum amount you'll accumulate, and if rates are better in the world, you'll get that. But if not, you'll get that minimum at least. So yeah, again, a very highly certain part of your portfolio. Maybe not 100% since rates can be a little bit different, but much easier to project within a very narrow range, which is nice. To have a piece of the portfolio that's a little bit easier to calculate and to rely upon.
Mhm. All right, so we've talked about fixed rate annuities, and you've referenced variable annuities. Uh, are there any other kinds of annuities, or is it just that two? Those two.
Those are the main two, and variable annuities, like I described, you'll be investing in things that act more like mutual funds. Even within that, you can take higher and lower risk within that, depending on what returns you want. The third kind, and I'm not sure there's any fourth I would add, any fourth one could be added into one of those three we're mentioning. The third being index annuities, which they work a little bit different than variable annuities in that index annuities tend to be tied to a major index, often the S&P 500, one of the most common, no doubt. You tend to bring your range of possible returns in a little bit more, which is to say, and let me compare index annuities to just investing in the general stock market, right? If you invest in the S&P 500, a basic index out there, still definitely can have very good years and very bad years, but there's this range of expectations. There's this range of history of what the best year is that you might have, what the worst year is you might have, and what's the average. If you wanted to be more aggressive than the S&P, you might invest in the NASDAQ. And in that case, the range of expectations, the NASDAQ has some higher return years even than the S&P 500, right? But it also has some lower ones. So that's what I would call a wide range of possible returns out there. So, and you could even get more aggressive than the NASDAQ, believe it or not. Like if you buy one individual tech stock, one of those big ones you mentioned earlier today, that the expected return or the range of returns on those could be just off the charts, right? Super huge if you do well. You could lose all your money if you do poorly, if you invest in one single, especially an aggressive stock, right? So that's what I mean by range of returns. I tell you all that because index annuities try and take that range of returns that you might have in a normal, even mutual fund, and bring them in more so that they're able to guarantee you like you'd referenced about a different type of annuity. They try and put a floor in there about the most that you'll lose or a participation rate, which is to say how much you will participate in the markets. Because they have to take the upside and the downside in. If they're going to guarantee you some kind of a floor on your returns, in other words, a minimum return on this index annuity that's tied to the stock market, right? I mean, you have to worry if it's tied to the stock market, can it lose all of its money, lots of its money? Well, that's what index annuities are for. The guarantee part of that is so that if there's a really bad year in the stock market, you're guaranteed to get a certain return. It might be small, but it's at least what they're saying is you're not going to participate in all of that downside of that bad year. The trade-off and the way that's paid for, aside from some fees, which we could talk about, but one other way that they pay for that downside protection is that they cap your upside. So they'll say, if the market's up in one of its huge years, I mean, the S&P 500 has had years when it's up 20, 25, 30% in a single year. They'll say, look, your maximum return on that is going to be X. And it might be 9, 10, 12%, 15%. So they may cap it at some number much bigger than that high year. But for some investors, that third type of annuity, an index annuity, might be right for them because they want to bring that range of possibilities in. They'll give up those huge up years because they want more protection when the market does have its bad years. You've seen those where it can be down 15, 20, 25%. They don't want that. And so that's how index annuities can take that range of possible outcomes into a more narrow band where they can still get some decent growth if the markets cooperate. But if they don't, they know they have some sort of guaranteed positive return, not just even a guaranteed lack of loss, but they want to earn some money. So that's how the third type of annuity works. Much more
Right.
participation in market-like investments.
Yeah, it sounds a little like what you would do with a mutual fund. You can have a mutual fund that's an index fund, and it is invested and balanced to mimic the stock market, whatever the index is, whether it's the S&P 500, the Dow Jones Industrial Average, whatever it is. It basically they constantly buy and sell stocks within that fund to mimic the returns of that particular index, as opposed to maybe a managed fund where you try and beat the returns of the stock market, of stocks in general. But it seems to me that with the indexed annuity, it's kind of like an index fund, and it sort of is a middle ground in risk tolerance, I guess, between a fixed annuity and these variable annuities, where you have a floor, you're going to get at least this much. There is an upside, but they balance it out, like you said. If the market goes too much higher, they keep that money against the rainy day of the downs, right?
Yeah, that's it. I've heard people talk very negatively about that upper, they're going to keep my money if I do better than so and so. Well, it may not be the right annuity for you, but understand there's a reason that they can't give you all the upside, and that's because they promised you to limit the downside. Exactly right. So that was a
Right.
good summary, Rick, Steve. Thank you. Yeah.
So how does that uh, how does he, when you talk about guaranteed rates of you get an annuity, it's your do-it-yourself pension, it's a stream of income. How does that track with inflation? So if you live a good 20, 25 years into retirement, we have inflation just naturally, not just what we've had high inflation recently. How do these different types of annuities deal with inflation and making sure that you have an income stream that's going to help you afford to live?
Yeah, a lot of it has to do with the fact that the market, there are parts of the market that will correct for that. Like you had mentioned a few minutes ago, we spent a little bit of time on those guaranteed, like even in a fixed annuity, which might have an adjustable rate, they have
Mhm.
this floor, this minimum that they'll give you.
Mhm.
One of the just natural dynamics in the annuity world is, let's talk about that dynamic a little, where they've said, well, the minimum you'll get on this is, I'm going to call it 3% in this today's world. Let me use three, Steve. So
Yeah.
let's say this annuity told you three, you're going to get at least 3% on this, but if rates are higher, you'll get more.
Right.
Um, we get into an inflationary environment. That's exactly the kind of investment that you will see that they're able to pay you more money. And it might sound like a free lunch at first, like, hey, we're not paying you that minimum. We're not going to pay you three. This year we're going to pay you four. And then a year goes by and hey, look, we're going to pay you five. And hey, look, the next year we're going to pay you six. Well, that sounds great if you didn't know what must be going on in the world there. It's some higher level of interest rates and inflation. So the reason they're able to pay you those higher rates is to keep up with it. So you will be able to keep up with inflation in most annuities unless you're locked into a fixed rate for a long period of time with no potential for a higher rate even. I'm not talking about the variable annuities that are invested in market-like stuff. I'm just talking the fixed conservative annuities like we're spending most of our time on today.
Right.
But natural market dynamics will be that if they are going to pay you those higher rates, it's because you must be in an inflationary market already. And so you will get those higher rates if the world starts to inflate and we start to get into that world. But the best point that you brought up though is remember if you're getting a guarantee on of 3 or 4 or 5% on an annuity, we should remember to factor inflation in there, right? So many people have different opinions on what inflation is. There are actually a couple different metrics we might look at for inflation. But let's say it's 2 or 3% right now, which
Mhm.
is a reasonable as we sit here today, Steve, because that'll change by the time people view this sometimes. But 2 or 3% inflation seems to be what we have going on at this very moment, depending on the metric.
Mhm.
If an annuity is guaranteeing you at least four, I just want people to understand what their real return is, what their after inflation return is. So just remember, it's not 4% above inflation. What the insurance companies promise you is the actual rate of return that you get. So really, you have to factor that into some point. So they'll keep up with inflation, annuities will, but hard to stay too far ahead of it. So it's a conservative investment for people who want to go that way, and it's why we don't tend to put 100% of people's money in annuities, just because if you're all locked into a rate that's just a little above inflation, there's
Mhm.
very little opportunity for growth or for even taking withdrawals from that money. So, as a piece of a portfolio, they can be really strong, just like bonds, right? But you have to do some work before you figure out what percentage of your portfolio you'd want in annuities. It may not be zero, but it's probably not 80% either. I've seen that out there, and usually that's not the answer, in my humble opinion.
Yeah. Well, we'll get into that in a minute, but we were talking about um, guaranteed income as a percentage.
Mhm.
So obviously, it seems to me that the more money you put into that annuity over time, the higher that monthly income is going to be at that rate of return. So when we talk about a 4% floor or whatever it is, it's a 4% rate of return on what you have in that annuity, right? So if you've got, just to make the math easy, $100,000 in there, then that's what,
So,
$4,000?
yeah,
Yeah.
yeah, it's a start anyway, but it's sometimes it's a little disappointing to crunch the numbers.
Yeah, yeah,
That you
but
can't keep
that's what
up
it
with.
you get people an idea that it's a percentage, not a dollar amount, and the dollar amount is going to depend on how much you have in that annuity, right?
Yeah, yeah, exactly. And I know you and I, and a lot of people think in percentages terms and everything, but as clients have come to see me, people talk to us, they really are trying to do the quick math like we would on, well, what does that mean in dollar terms? But you're right, for every $100,000 you save up, Yeah, I think your number's a good one just because it's an easy number to scale from there.
Right.
For $100,000 you put away at a 4% promise for the future, right? Your future income may just be 4,000 additional dollars to your household per year. So for some people, they need to put some magnitude of that. 100,000 you can easily calculate if you put away 200 or 300 or 400,000 away or whatever the number is. But it's a good way to look at it. And so the larger you can grow that piece of your money, the larger you'll have that plus Social Security plus whatever other income you're designing. But it's a great way to figure out how much in the guaranteed income bucket, if you will, how much
Right.
you'll have. Started talking about earlier.
Now, a few minutes ago we were talking about how much of your overall portfolio is in annuities. I guess the next question is, uh, when are annuities a good idea for someone, and when are they a bad idea? And does that, to some extent, I guess, depend on how much of your portfolio you want to put into an annuity?
Yeah, so there are a bunch of factors, and I don't make it sound overcomplicated. The way I look at annuities is it's a very customizable decision, right? So you would sit down and for yourself, or if you and I are, if I'm sitting down with anyone, let's talk about what level of risk they want in their total portfolio or with this piece of the portfolio, right? And then we might be charging or deciding which kind of annuity we want to use, right? So risk is one thing.
Mhm.
What kind of rate of return are you striving for might be another question. And again, for all of their money or then for a piece of their money, like a more conservative piece of their money. Um, you also want to look at the timeline. So that's actually a very big one. So when we're deciding, is this right? Is it not? How much might be right for it? When might you need this money? So if someone tells me, I want to put a chunk away for my retirement or for our future income, but there's a possibility I'll need a big chunk of this in 2 years. I might build a house. I might, whatever the reason. If you need liquidity, remember that that can be a consideration here because depending on your contract, could be locked up where you can't get at it
Mhm.
within a certain period of time. Most often it's simply a financial penalty if you withdraw the money at all in the short term. And by that, I mean, if you withdraw them in the first 5 years, the fees might be significant to take your money out.
Mhm.
So yeah, when you need your money is one of the biggest factors. So knowing the level of risk that you want, knowing how much you're striving for in terms of a rate of return, or like I talked about earlier, what's the range of possible returns you might get, that can help guide you. If you need the money at all in the short term, you probably don't want an annuity. There's some different varieties out there, but most of annuity investing is for the longer term. So I'd actually elevate that to number one. If I were doing these in order, that's probably the number one thing I would say is if people need this money sooner than later, you
Mhm.
probably don't want to do it. And then finally, figure out not just the timeline of when you want the money. If you're thinking about an annuity at all, think about what your timeline is like. When might you want the income to start? How long do you want that to last? Because we didn't talk a lot about that. I kept mentioning, it's an income stream, can be an income stream for life. You could set up an annuity and just say, I just want an income stream for 20 years or 10 years or 30 years. So those are available as choices out there.
Mhm.
And the final consideration is it right for you or not? You might have someone else in your life you'd like to protect also. Often it's a spouse where you'd say, look, I don't want it just for my life, but I want it for my life. And if something happens to me, I want my wife to keep getting that check. So I want
Mhm.
it joint life is what they would call it. So that's a possibility too. So I think in most of those cases, if you can check off the boxes of how much you're trying to get as a return, what your risk level is for things, and what your timeline is for yourself and perhaps anyone else in your life, like a spouse. I think those are great considerations for it. Oh, and the final one is it encompasses some of those others, but it's the cost. Who might it be right for and who might it not be right for? There are costs with all these things that we've just talked about with these guarantees.
Mhm.
Cost is in terms of lower promised returns or just flat out costs to the portfolio that money will come out of the portfolio. So you have to be aware of really for each person making the decision, the cost worth what you get for it. So I'm not going to say blatantly if annuities are right or wrong or expensive or cheap. It's a matter of do you understand what the costs are and are those costs worth it for you for the benefits that you do get?
Mhm. So certainly annuities are not for any kind of short-term savings or investment goal. I mean,
That's the biggest thing.
if you're using this for a college fund or down payment on a house or things like that, or a dream vacation, more shorter horizon savings or investment goals, you really shouldn't use an annuity. And also, I guess it depends on when you start. I mean, if you're looking at annuities in your 20s, that's a different consideration than if you're in your 40s or 50s, right? Because you have more time to put money in there. And as we said, even at a 4% floor, it can be not a lot of money per month if you don't have a lot of money in it, right? So it's what your retirement horizon is and when you're starting.
Yeah, yeah. So they can be very good vehicles for younger people to sock money away for the long term. Now they need to look at their other options. Would a 401k make just as much sense, or an IRA make as much sense? So they may have other options. But your point about the strength of investing early, because you can invest smaller amounts that will compound over time, absolutely apply here. So yes, absolutely in that case. And then
Mhm.
for older people, they still might be right for people closer to retirement or in retirement for a number of reasons. Sometimes people have maxed out. I didn't even mention this, but who else can they be right for? They could be right for people who have maxed out their employer plans where they can't put any more tax deferred money away for their retirement. Even if they're approaching retirement, they might be hitting the maximum. I mean, it's a good position that they might be in, but they may have some extra money from somewhere that they would like to save for their retirement. And annuities can be tax protected as well. So that may be an alternative to, actually, they generally are. So it could be a good alternative if you've maxed out your retirement plans as well. I didn't mention that as another situation where who they could be right for and who they could be wrong for. Well, that's another one it could be right for. Someone trying to, like, getting close to retirement, wants to put a little extra away, but can't do more to their employer plan. They might think about an annuity there too. And in that case, they're not as focused on long-term compounding growth before they take money out. They are more focused on a couple of the other attractive parts of annuities, which is tax deferral, and again, back to the original kind of annuity, they're just trying to sock some money away that's going to pay them over a long period of time. So they may not have the 40 or 50 years to go that a young person would, which is where your question began. But even close to retirement, for the right people with the right dollar amounts, they could still be attractive to set up lifetime income streams, which is one of the main goals of annuities. We have to remember that that's the main goal. These are mainly
Right.
income scheduling assets, income growth assets. Yeah.
So if you get into these tax deferred annuities where, and you make a good point that after you put, maybe you've invested the maximum in either a traditional or a Roth IRA, you've already reached the maximum of a 401k, and you want something else that'll give you a tax advantage at least now, then a tax sheltered annuity would be a good choice there.
Yeah, yeah. So it might take some number crunching with your accountant to see, do you need the tax deferral? Where do you think rates will be in the future? So that becomes a little more complex calculation. But as you said it beautifully and simply, yeah, if you do need a little more tax deferral to get today's tax bill down and it pushes the taxes down the road, exactly. Then one of the tax advantage annuities could make some sense. Yep. Well
Mhm.
said, Steve.
So, as far as the fees, how does that work? I mean, I know, for example, a lot of financial planners now and stockbrokers are not so much on a commission based, but their fees are based on a percentage of assets under management, usually one, sometimes 2% annually, percentage of assets under management. How do fees work for annuities? Are they similar? Do they vary? How does that work?
I'll go with your the word you just used. They vary. That's the way to say it because there are. Actually, it's a good thing. There's an innovation in the annuity industry these days where some of them are available in fee-based accounts, which is to say you don't have to pay a big upfront load. And I should cover what that is for people if they're not used to those, because that used to be the way things were done with almost every kind of investment. So in any case, there are three basic types of fees people should know about with annuities. Let me cover that. So the traditional annuity, there are going to be mortality and expense risks. So M&E risks they would call them. Those are usually in variable annuities, not so much in fixed, but that's a piece of your fee. There will be administrative fees, no matter which kind of annuity that you have. So you'll have admin fees,
Mhm.
and then there may be surrender charges. There may be sales fees. That's what I was talking about before, where you're paying a certain load upfront, a certain percentage upfront. Not so much seen as much in the annuity market, not as much in the annuity market these days, but just ask the questions. If I'm putting $10,000 or $100,000 into this, do I have $10,000 going to work? Do I have $100,000 going to work? Or is there some fee coming out of that beforehand? So always ask that question and read up about it. But aside from any sales charge on that, make sure you know what the M&E fee is, the administrative fees, and if there are any surrender charges. And that must be very well explained in their simple documents that can't be buried on page 37 of the prospectus anymore or anything like that. But even if it is, that's definitely something you want to know. There are fees involved in there, and they can amount to. And again, I apologize. I'm zigzagging back and forth a little from fixed annuities and the variable. Fixed fees tend to be much more simple because they're often quoting your return net. Like they have to worry about how to make that money. You'd asked a question, Steve, before about how do they invest this money and how do they guarantee that on fixed annuities, the safest kind, the main kind that we're talking about, that's up to the insurance company where they get their revenue from that. If they're promising you 4%, right, it is a net 4% to you. So if you put $10,000 away into that, you're getting a 4% growth on that number. When you start to get into variable annuities and fixed index or index option annuities, then these other fees that we're talking about are become more prevalent that people should know about. So it's always mandated these days. I mean, we don't always love more and more and more regulation. This is an area I am completely behind regulation, though. They've made it very clear that fees have to be upfront and stated and clear for people to find. So dig into that. It's easy to find in the offering documents for any of these. So make sure you look at all that. Then let me flip, sorry, real quick back to where I'd started, which is sometimes though we have annuities with very low fees now, as long as they're done in a fee-based wrap account. Because you had mentioned a lot of money managers, a lot of investment people these days work on a percentage of the assets under management, right? Um, and annuities done a certain way, like those ways that I just mentioned with all those outside fees, they would be sort of outside of that scope usually. There are annuities these days that have lower fees that can be done in they may call it a fee-based account or a wrap account, where the advisor might put their fee on that asset as well, but you'll save a lot of those internal fees that I talked about. The M&E plus admin fees might be much lower. So it's all about asking the question of what are all of the fees? And if you're working with someone, ask them to break them down for you. It is nice to know the separate, if you're working with a financial advisor, okay, what are you going to get paid on this? And, what are the internal fees that will be coming out of this? And if you ever work with someone that minds asking those questions, well, you got to think twice about working with that person. We're just big fans in being transparent with fees. And so ask them truly, I say it jokingly, but ask those questions. You should understand, what is your advisor, if you're working through one, betting on that at all? And then what are the internal fees I should know about? Great question to ask.
Mhm. Well, we've certainly covered the gamut here. I think we've given listeners a good primer on annuities and all the different issues. Naturally, these are things to think about and then certainly ask about. And speaking to a financial advisor and financial professional, don't try this at home, folks. Work with somebody that has your best interests in mind to make sure you make the right decisions. So if anybody wants to reach out to you, Michael, with help on not just annuities but bonds or any other investment advice or financial planning, how can they get in touch with you?
Email is probably the easiest way. They're welcome to reach out to Michael at glenairfamilyadvisors.com. And just know that Glenair is Glenayr. That's the only tricky part about that. So yeah, feel free to reach out or look us up. I'm on LinkedIn, and you can also go to our company website. So thanks so much.
Yeah, we'll have all that information in the show notes. And hey, this is your fourth time out, Michael. I'm sure there'll be a fifth and a sixth at some point. But thanks for coming on the show and telling us all about annuities.
Thanks for having me, Steve. I appreciate it.
Mhm.